Hey everybody, welcome back to Drawbridge Finance. The other day I got a very interesting email from one of my subscribers asking us a very specific question about dividend portfolios versus the SPY ETF. And I want to do a quick chart to analyze some of the data that I pulled up from last year. As always, my name is Levi Woods. I'm not a financial advisor. I don't work in the financial industry, and this is an opinion channel about money. My goal with this channel is to help people make more money. We want to all just get rich together, so that is my goal. If you guys are new to the channel, please click the subscribe button down below because I think you're going to find a huge amount of information on this channel that is unlike any other channels out there offering financial opinions. All right, let's get right into this. The question comes from Dave Robbie, and he asks, since you illustrated in another video how to get 7+% yields with ETFs, SPY, and QQQ, why would I want to invest in individual stocks even after researching them? Research statistics show that only a very small percentage of people can successfully pick stocks. Would it not be better and easier to just go with SPY and QQQ ETFs where there is no researching required? Just invest each month to dollar cost average and let it grow over a long time. Thanks. Dave, this is a very good question because building a dividend portfolio does take a bit of time. That's why I always recommend that people go and seek help from a professional financial advisor. If you can find somebody that's actually going to help you build a dividend portfolio, then they are professionals. They will help you do that. I have an advisor still, 22 years I've been investing, and I go and I rely on that person to feed me information. Now, that said, we also know the S&P 500 grows at an average rate of 7.8% per year. And what we have available to us is ETFs. We have electronically traded funds, or an ETF, that literally track the S&P 500 minute by minute over every trading moment of the day. It means that we can spend a very, very small amount on commissions. The ETF fees are very, very low, and we can basically track right along with the S&P 500, and we can grow our portfolio over time. On top of that, the ETF even pays a dividend, pays a quarterly dividend. Now, it's not huge. I personally am a high dividend yield investor. So I am looking for dividend yield between 6% and 10% as an average for my dividend portfolios. The SPY ETF is less than 2%, but we're going to get into that. I'm going to show you the details. But the big thing about why I personally choose to invest in dividend stocks as opposed to the SPY is because I want to generate monthly income. And it depends on where you are in your portfolio life. If I was just starting out and I only had a couple $100 to invest each month and I had a very, very small account, I would absolutely buy into the SPY and the QQQ. That would be a very smart investment because I know that the investments that I make are diversified and they are going to grow over a long period of time. But I personally am not in that situation. I am getting close to retirement. I'm 10 months away from being able to fully retire because I know that my dividend income stream per month is going to equal my expenditures each month. So without having any other source of income, I can live off my dividends. So that's why the income stream is so important. What I'm going to do is I built a little spreadsheet and we're going to look at the income stream from SPY investments comparatively to a dividend stock portfolio that is one of my model portfolios that's available on my Patreon account. This is the expected performance versus the actual performance of a dividend stock portfolio versus the SPY ETF. So we're going to do two quick snapshots. The first one is going to be starting with a model portfolio that has $1 million value as of January 1st, 2018. The second portfolio, which is going to be Bob's portfolio, is just the SPY index. So the same $1 million investment, but we're going to look at only investing in the SPY ETF. We're going to project out what our expected dividend yield is, and then we're going to pretend like we require this money. Once somebody is retired, they actually need to live off of the dividend payout or their stock portfolio. So let's take a look at the chart. We've got Alice set up. She's got 10 companies that are all fairly high yield dividend investments. Most of these are Canadian, 9 out of the 10. And what I've done is I've pulled the open price, and these are prices from January 1st of 2018. So if we wanted to buy A&W $1.UN on the TSX, the open price on that day would have been $33.69 Canadian. What I want to do is build a portfolio that equals around $1 million. So what I've done is I've equally divided these 10 stocks, $100,000 each. So in order to get that, we would have to buy 2,968 shares at $33.69 to equal $100,000 Canadian. You'll notice that SNH, which is American, obviously the stock price is in $19.12 with 339 shares, and we would have a market value of 79,000, and this is actually in US dollars. So the subtotal US dollars is here, it's equal to this. Then with the exchange rate on that particular day, because exchange rates factor into any investment strategy, we actually end up with around $1 million portfolio, just $1 short of $1 million with this particular scenario. Now, Bob's portfolio is only going to be comprised of one ETF, and that's the SPY. So the value was $267.84 US, which means that he would have to buy 2,957 shares, which would give him a total of investment of $791,928 US with the exchange. That gives us around $1 million. This is rounded, but it's very, very close to $1 million. As a dividend investor, one of the most important things to me, as I said before, is the actual income stream. So what I want to do is I want to make sure that I'm making a monthly return. So what I'm going to do is I'm going to estimate out, based on the past year, what I expect to make in the dividends from each of these 10 companies, including the SPY ETF. So let's take a look at that column. So the expected yield for A&W is $1.63, and this is based on the 2017 figures. So that estimated dividend yield at the current price of $33.69, which is the price you would be buying this portfolio at, would be around 4.84% return. Boston Pizza pays out $1.38, a return, an annual expected return of 6.3%. Of course, we can't see into the future, but we're using trailing data to project what we expect. All of the green ones are stocks that are paying a dividend yield between 6 and 10%. And that, as I said before, and I've said many times, that's my expected range of high yield dividend stocks. What this also means is we can put a dollar value to this. If we bought $100,000 worth of A&W on January 1st, 2018, we would expect to get an annual payout of $4,844 over the course of the year. A&W pays monthly, so you would get 12 payments that total $4,844. And we can now see that each of these pays out a total, and with the conversion, our $1 million investment on January 1st is expected to pay out $66,207. Now, for somebody that's retired, that is a fairly good income. If you have $1 million portfolio, I would expect that a lot of people would be able to have enough money to live off of a $66,000 income per year. If you've got your mortgage paid off and you've got your car paid off and you just want to travel and eat out and live and have some money to spend, $66,000 is a relatively good income for a retiree. The dividend yield and average monthly dividend income is 6.62% based on these above figures, or around $5,517 per month income off of the investments. Now, this is cash. We're not reinvesting these dividends. We're removing the cash from the account and spending it. So we can just do this perpetually forever in theory. And that's one of my rules: invest for forever. If you're not familiar with my rules, you should check them out. I'll put a link up there. The SPY ETF, the 791,000 US, which works out to $1 million Canadian, it only pays a dividend. The expected dividend yield was going to be $4.80 or 1.79%. Now, I said that before. The SPY ETF does pay a dividend, but it's quite low. It's not in my range. That's why it's red on this chart. So 1.79%. $1 million investment is going to pay approximately $17,921 expected yield. Now, that is based on the exchange rate as of January 1st of 2018. Of course, exchange rate differs throughout the year, and that's going to affect how much money we actually receive as Canadians. The expected dividend yield and average monthly dividend income is 1.79% or $1,493. This is average per month, $1,493. Now, I'm going to show you why that works, how that works out, because this is quarterly paid, that dividend. The other column that I've added in here, just to make sure all things are fair and just so you can kind of see later on the chart, is how much each of these is worth. 10% of the account across 10 different stocks works out to 100% of the portfolio. Planning and using that money from a dividend portfolio is so simple because we're making $5,517 per month in dividends. We literally just remove that money, make a withdrawal, and spend it how we see fit. It's a really simple transactional thing. We're not buying or selling any shares at all. We're just using the dividend to live. Now, the SPY, on the other hand, isn't generating enough income for most people to live. I hope that when I retire and I have like an income stream that is reasonable, it's not going to be as low as $17,000. So I'm going to have to sell off some of these shares month by month to make up the difference. So that's the comparison today. I'm going to compare Bob and Alice. They're both going to live the same lifestyle. So Bob is actually going to have to make a transaction and sell off some of his SPY ETF each month in order to make up the shortfall, because he's only collecting an average of $1,493 per month off the dividend. So I built a sheet specifically for this, just to look at what's going on. Now, Bob's monthly income goal is going to be $5,517. Now, that is based on Alice's figure. So we're trying to match Bob to Alice so we can compare apples to apples. And we're going to do this all in Canadian dollars as well, because I'm Canadian and I always factor everything in Canadian because the exchange rate affects things. So January, we have a value of $267. The exchange rate was 1.26274, and the value in Canadian dollars of the SPY ETF per share was $338. The number of shares we know was 2,957, and the value was, this is the non-rounded number, $1,093. Now, the dividend on the SPY ETF is only quarterly, so it doesn't even pay the dividend in January. So I have to sell shares in the very first month to make that $5,000. In order to make $5,517 at $338 per share, I have to sell 16 shares. So that's what I do. My share value for February, the share value has actually gone up to 281 or 345 Canadian. The number of shares in my account has actually gone down, 2,941 shares, because I sold 16 of them. So again, we sell another 16 and have another income of $5,517. In the third month, I get the dividend. So the dividend payout on this is actually quite large, $4,118. So I only have to sell 4 shares, or $1,398 worth at $348 each, in order to make up the monthly value of $5,517. I'm going to populate down this chart. We're going to take a look. So each quarter, so we have January, February, no dividend. And then March, we have the dividend payout. Then April, May, June, we have the dividend payout. So you can see pretty easily 16 shares. You're selling off shares every single month, and that's reducing the number of shares that you have. The dividend income he made was $16,411. He had to sell over the course of the year 141 shares, and he collected $49,795 from those 12 transactions selling the shares. And his total income for the year, dividends plus capital gains from selling the shares, worked out to $66,000. The interesting thing about this was the SPY actually had a fairly good year. So his average price would have been $338 Canadian at the beginning of the year, and every single month, including December, he was actually selling for a greater value. As of January 1st, though, the share value had dropped to $331. So one of the risks that you take by using a SPY ETF as your major investment strategy is that when you're selling it off, you're at risk of what the value is on that particular day. If we continue forward, he could have had a really bad year. He could have been selling for a loss on each one of these transactions, and he was lucky that he actually sold for a profit on each one. The major takeaway from this, though, is that at the beginning of the year, he had 2,957 shares. At the end of the year, he only had 2,816. That's a reduction of 5%. 5% of his initial investment was sold off. Now let's go back to this original chart that we were looking at, and we're going to fill out the January 1st, 2019. So we're going to go into the second snapshot. If we look at A&W, you can see that the price last year was $33.69. It's now $34.13. But the important thing is here that we didn't make any transactions. We were collecting a dividend income, but not selling any shares. So the shares in January of last year, $29.68, are still $29.68. And that's the same for all 10 of these. These share values are equal to the share values of the previous year. What I want to show is what we actually collected. So we expected to make a 6.6% return. What we actually collected was 6.77. The dividend portfolio, a bunch of these dividends actually went up. We were expecting $1.63. We actually made $1.92. Boston Pizza, we were expecting $1.38. It paid out $1.38. Of these 10, 5 of them increased in value, 4 were exactly what we expected, and 1 decreased. 2018 was not a particularly great investment year, and we actually saw our portfolio value decrease. But we weren't selling anything, so we weren't taking any capital losses at all. The value in Canadian dollars at the end of the year, or January 1st of 2019, was down to $844,000, but we actually hadn't made any transactional values whatsoever. If we were still in the building time frame of our portfolio, we would have actually been buying stock at a lesser value, and this would have decreased our dollar cost average and would have been beneficial to us. Last year was a great year to buy dividend paying stocks, especially in November and December. Since January 1st, and now we're sitting in the middle of February, those values have actually increased right back up, and there's almost no loss. But this was a snapshot year to year, so I wanted to show that the value could change over time. There is risk in this type of investing. There is also risk in the SPY ETF, so both of them have risks that are involved. The bottom line was we expected to get $5,517 per month, but what we actually got was $5,641. We had an extra $120 a month to spend on a special dinner if we wanted to, or a nice bottle of wine. Pretty great to have that extra income coming in. What happened with the SPY ETF? So the SPY ETF, US dollars, or let's compare in Canadian, we had $1 million. The total went down to 933,000. So we saw a slight decrease there. Not particularly advantageous to the SPY portfolio. We expected a 1.79% or around $14.93 a month. What we got was a 1.76% return with only a $1,367. We actually missed our target by $120. The other thing that we have to factor in, and I almost didn't mention this, is that we have to incorporate in our transaction fees. In Alice's portfolio, she did absolutely no transactions. She didn't buy or sell any shares. She only withdrew the dividend cash. Bob's portfolio, he actually traded 12 times. So each month he had to sell off shares. There's a transactional fee that goes along with the selling of those shares. Now, if you're a self-directed investor and you have a really low cost account, you're probably only paying $10 a trade. So it's pretty nominal on $1 million account, or $67,000, $66,000 that we're collecting over the year. You're only paying $120 in fees, but it is an additional $120 in fees over and above the $120 missed dividend payout. The only other column that I can really go over is looking at the portfolio weighting. And of course, when you're looking at a portfolio of the SPY, it's still 100% invested in the SPY. In the dividend portfolio that Alice has, you've got the percentages have gone up or down. So what happens is we can see that Boston Pizza has decreased in value. It was trading at $21.91 and it's now trading at $15.11, and it's only worth 8.2% of our account. These would indicate times where if the dividend yield is still strong, 6.3%, we're looking forward and saying, okay, well, maybe I want to add some more to this position, these ones that have reduced, and not be purchasing something like Summit, which has run up and is now worth 15% of my portfolio. So we can use this percentage of account to justify what we're going to buy next and looking at the low percentage. Anyways, I hope that's been informative for you guys. I love making these videos. I hope you do too. If you do enjoy them, please leave a like down below, leave a comment, ask your questions, and let's get rich together.